I can see, and what I can see is what seems to be on air, which is me and my bookcase. So I don't know if there's just some sort of issue with the servers that we're broadcasting through, which are not Simpler servers, by the way. So I'm not sure if just our streaming service is having some issues, but how about an audio and video check before we kick this off? Just like I would if I were doing the chat in the room. Is the audio and video okay? You can see me and hear me? All right, cool. Excellent. All right, let's just boot this off again then. Thank you very much. I appreciate the feedback, gang. All right, so let's just kick it off from the top. So first of all, welcome. I'm glad the video is working now. Welcome to my office, well, my bookshelf anyway. All right, welcome to another episode of Forex Friday. All right, so what we're talking about today are watch lists. I'm going to share with you the watch list that I have given the folks at the Forex Mastery. We're going to talk about the time frames and the way in which your watch list has to adapt. All right, so everything's good. All right, love it, love it, love it, love it. Okay, everything's great. Yeah, this is a really good service. It usually is very stable, and who the heck knows, you know, hiccups happen on the worldwide interweb, which I'm completely convinced works via fairy dust, right? We just don't know how the internet works. It just does. All right, so let's go ahead and kick this off. Now, first of all, what we were doing before, you could probably hear me in the audio, is we're juxtaposing short-term, more day trading oriented watch lists as compared to end of day or daily time frame watch lists. So the first sort of guideline to keep things manageable, if you're trading on and to me, day trading is really going to be a 60-minute time frame or less, and really more like a 30-minute time frame or less. So think about day trading the Forex, 24 new candles per day on a 1-hour chart, 48 on a 30-minute, and on, right? So at some point, when you're dealing with the frequency, the speed at which you're getting new candles, your watch list really has to accommodate that and typically be a shorter, smaller watch list. How do you form the watch list? That goes back to the conversation that we talked about last week, which is looking at the contrast. So what I'll recommend is, and if you recall from last week, we use a site called Finviz, FINVIZ.com. Finviz has a heat map, like a little horizontal hierarchy of what's strong and what's weak, and you can set how far the look back is: 1 day, 1 week, 1 month, month to date, 1 quarter, quarter to date, year to date, and the year. The shorter the time frame you're trading, you're going to edge closer to the 1 day relative performance or the 1 week. Longer term time frames, say daily time frames, even 480-minute time frames, you're going to look at, say, the 1 week, 1 month, maybe even the quarter, because now you're looking at more sustained moves and a larger time frame. Now, let's not confuse time frame with time horizon. Time frame is what is the interval chart you're looking at. Time horizon is, well, how far out do you sort of guess, because it is sort of a guess. How far out do you suppose you'll be in the trade? Now, it's pretty easy. The supposition of you being in a shorter term time frame for a shorter period of time is a pretty easy supposition, right? On a daily time frame, it's nothing to be in the chart, trade on that chart for days, if not weeks, sometimes even months, okay? We don't have rollover to be bothered by, you know, like in futures trading. We don't have expiration, say like in options trading. It's more like a stock. You got it, you just can roll with it. You know, there's no time-based sort of forcing you out of the trade because of rollover, expiration, etc. So that's something that's great. So shorter term time frames, you want to make sure you're revisiting the watch list, the contrast, about evenly matched with the interval that you're looking at. So say a 1-hour chart, you should look back at the contrast about every hour. And if there is an economic event that transpires during that hour, you're going to want to reassess it, because that economic event can oftentimes really reshuffle the currencies and their lineup. Okay, so the watch list that I have for the Forex Mastery members, what I will send out as trades, most of my trades are sort of a portfolio of currency pairs. So it's a little bit longer term. So we're talking about daily time frames, 480-minute time frames, and the expectation that I'll be in the trade for days, if not possibly weeks, but definitely days. So, by the way, if you're interested in the watch list and the sort of tactics that I'm using and just flat out getting my trades that I set up kind of in this portfolio, mostly daily or 480 minutes, so we're trying to take advantage of those longer term trades. You can join us at the Forex Mastery. It's at simplertrading.com/FX. And you can see what I'm doing, how I'm managing the markets day to day, and how I am building these watch lists. So I'm going to give you a little sneak peek at this watch list. Now, this was the watch list for this week. Chances are many of these currencies are going to be on next week's watch list, but on Sunday, really starting today, I'll start to re-examine which of these really still is valid and which ones may be better than they were this past week and maybe less better. None of them are going to be bad because we're already looking at pretty healthy trends. That's what's great. All right, so the watch list that I prefer right now is a double green watch list. Now, what is that? That's some Ragheeism technobabble. What that actually means is that the structure of the 8, 13, and 21 exponential moving averages are suggesting nice short-term sentiment and momentum in one direction. And then my wave, my 34 exponential moving average, is telling me that the longer term, the more trend-based assessment of the market is also in that same direction. So the way that I look at a trend is it's the way that people think, sentiment, plus the way that the market is moving based on how they're thinking, momentum. When you get enough of that organizing, you get a trend. So trend really is sentiment plus momentum equals trend. So we're focused on trends and of the longer term variety mostly. So I still love the Aussie. We've talked about the Aussie in many, many episodes right now. If you've been following me in these episodes, you're long Aussie, as am I. And that journey has been a great one. And I'm still focused on really 3 relationships. Aussie-US, we've had on our watch list for a while in these episodes. Aussie-Yen and Aussie-Canadian dollar. Aussie-Canadian dollar is relatively new. We've seen some recent Canadian dollar weakness, so we're capitalizing on that by shorting Canadian dollar and buying Aussie. The other group, and this has come on lately with the US dollar weakness, is Euro Canada. So once again, Canadian dollar is a weakness story. Now we're shorting that against the Euro Yen. Why is Euro Yen working? Euro Yen is part short dollar, part long equities. So if you love the narrative of being short the greenback and you still want to bet on strong stocks, Euro Yen long is a really good one. That's on our watch list as well. Finally, Euro US. I actually, as much as this is the most popularly traded pair, it's the biggest market in the world of any kind, gang. The largest traded market in the world is Euro versus US dollar. One of the reasons I don't recommend it a lot, I'll trade it, but I don't recommend it a lot, is you're completely right or you're completely wrong. Your margin for error in the Euro US is next to nothing. Either you're spot on in your assessment of the dollar, in which case you've bought or sold that, and then the opposite in the Euro, or vice versa, but there's no room for error. There's never going to be a day where both the Euro and the US are strong together or weak together. So you're absolutely right or you're absolutely wrong. And it's the only pair that actually behaves that way. So while it's an awesome pair, and if you've got it right, you're really going to get a great move. But if you've got it wrong, there's no latitude at all for error. I can be in the Euro Yen, long Euro, short Yen, and even in many ways long equities. That's the play. But I can have a day where the Euro is strong and the Yen is strong, and it's not going to derail my trade. Where the Euro is weak and the Yen is weak, and it's not going to derail my trade. The only thing that's going to derail my trade is a prolonged period of Euro weakness and Yen strength if I'm long Euro Yen. And so it's a much smaller possibility that derails my trade as opposed to that very binary relationship between Euro and US dollar. All right, so next group is the pound, okay? And again, these conversations, these pairs, this watch list, and the trades that come from them, I share as live alerts. You know, when I am actually looking at a trade and I'm keying it in, you guys are getting an alert too. And that's what we do at the Mastery, which is over at simplertrading.com/FX. Third group, pound Aussie. So pound Aussie, pound yen, and even pound US. Pound is an interesting one. It's a little aggressive right now, but I'd keep an eye on the pound. It's been kind of coming back as a strength story. It's probably my least favorite. So if you're going to go take a look at the pound pairs, please put them as they're listed here, which is my third favorite, not as ideal as long Aussie or long euro. So pound Aussie, pound yen, pound US. And really what you're looking for is the structure and the trend. You really want to see clarity on from one end of the currency or the other, or preferably both. What does that mean? You want to see one currency strong while the other currency weak, which goes back to that contrast conversation. And if you guys missed that broadcast, and unfortunately we might have to re-record that conversation because the video, go figure, was very jumpy. It was kind of a messy episode where my audio and video were not in sync for whatever reason. So maybe we'll redo that one and revisit the topic of contrast. The last pair on the watch list that I sent to the Forex Mastery folks, and again, these are folks that have decided that they want to take a deep dive into the topic of really elite Forex trading. Topics like contrast, topics like understanding heat maps, topics like playing trends longer term, building a portfolio of currencies, things that I've done now for 2 decades. They want to take a deep dive, right? And that's really what that's about. Now, if these episodes are where you want to start, that's cool. And I really appreciate the time. And, that's terrific. You might want to instead consider a class. You may not be ready for building a portfolio of currency trades. You might say, Rag, I want a little bit more education. These Forex Fridays are great, but, let me check out how you trade. And that's cool because we have a class called a Forex Freedom class, which is at simplertrading.com/Forex. The last pair on my list is dollar Canada. So you'll notice throughout these groups, there's been a lot of emphasis on Canadian dollar shorts. So I would call that the driver of a lot of my trades right now, which is this wanting to short Canadian dollar against the strongest currencies that I can find in terms of contrast. Again, check out FinBiz, FINBIZ, and look at the different segments of look back, 1 day, 1 week, 1 month, 1 quarter, and see, again, match up the time frame to the type of trading you want to do. A lot of what I'm doing here with this list that I'm sharing is the longer term, little riskier, not because they're lower probability. Who the heck wants to take a low probability trade? I've never really understood that. I'm not going to look at low probability trades, but some trades are riskier. Risk being defined. Now, you're going to want to write this down, and we'll definitely revisit this in upcoming episodes as we wind down this one. Risk is defined as the distance from your entry to your stop. Also, your position size times the point value per pip. Okay? You can even factor in volatility analysis into that, because volatility analysis is going to give you a really good feel, a pulse of the market of what kind of movement do we get hour to hour, day to day. So that's another part of understanding risk. But when you've decided to take risk on, in other words, you're taking a trade, your risk is the distance from your entry to your stop times your position size times the point value per pip. You have to know that beforehand, which is why we always send out 3 different levels, typically almost always 3, per trade alert. And that's so you can, as I like to say, choose your own adventure. You can determine which one of those levels from a risk standpoint is right for you. And you really shouldn't take a trade that isn't affordable. And that's a word that isn't mentioned in trading enough, but it's so important. Is the trade affordable? Not whether it's a good setup, not whether you like the way in which the indicators and the squiggles line up, but can I afford to be wrong? That has to be, especially if you're trading with a small account, that has to be sort of the barometer for whether or not you take the trade. All right? So thanks as always for joining me for another episode of Forex Friday. I'm glad the tech cooperated with us. Excellent. All right, so if you do have any questions or you're watching this on replay, of course, thank you for your time. Leave a question in the comments area. I do come back and follow up with any questions that were left. And I'll see you in the next episode. All right? Okay, gang, be good to each other. I'll see you next week.